The official rate is trying to tell you a bedtime story, but the street rate just ripped the blanket off the whole room. And once that spread widens, the market can't unsee what's really happening. Because this isn't a random people are nervous move. It's a mechanical squeeze in a system where dollars have rules, dollars have gates, and dollars have deadlines. And if you understand the one hidden deadline that's been quietly moved forward, you'll understand why hedge demand is building right now, why the parallel market jumped instead of drifted, and what levels and triggers matter over the next week or two. Let AS anchor the reality first. Iraq, S official exchange rate is being held steady for policy and budgeting purposes. And early January reporting says the central bank set the 2026 budget exchange rate at 1,300 dinars per dollar, down from 1,320 used in 2025. In the same breath, the parallel market is printing a totally different price. Local exchange shops were quoted around 800 dinars per $100 in Baghdad in early January, with similar numbers in Erbil and Basra. That's not a cute little gap. That's a premium, that's a pressure gauge. And when the premium expands while the official rate barely moves, it tells you the truth. The stress didn't vanish, it migrated. Here's the part most people miss. The headline isn't the move, the signal is the shape of the move. A gradual grind higher can be sentiment. A jump is usually constraint. A jump is what happens when sellers step back at the exact moment buyers can T-wait. And that's where the real pressure starts. So what changed? What makes buyers suddenly unable to wait? This is where the hidden detail matters, and it's not a conspiracy. It's a calendar and a workflow change. In late 2025, Iraqi economic coverage pointed to a government customs rule tied to prepayment, specifically that customs duties would need to be paid before banks process foreign transfers, with a December 1st effective date being discussed. Local reporting described traders halting dollar sales ahead of that shift, and that alone is enough to create a violent temporary vacuum. Because if you tell importers and brokers your paperwork clears only after you pay earlier, you just pulled forward demand for dollars. You didn't increase the desire for dollars, you changed the timing. And when you change timing in a market with limited liquidity, price doesn't adjust politely, it jumps. Think about the import supply chain like an assembly line. The moment you force one step to happen earlier, pay duties, prove documents, clear compliance, you force cash to be deployed earlier, working capital gets squeezed, inventory gets delayed. And in a country where many goods are imported, delay isn't an inconvenience. It's a threat to stock, to margins, to relationships, to survival. So the importer doesn't sit there waiting for a better rate, like a day trader. They pay up. They buy the dollars now, but that's not the part that matters. The part that matters is what everyone else does the moment they see that behavior. In the parallel market, dealers and traders don't behave like a charity. They behave like risk managers. If they believe a wave of forced buyers is coming, buyers who must transact regardless of price, they widen spreads and reduce size. They quote you higher, they quote you smaller, and the moment uncertainty rises, sellers disappear first. That's basic microstructure. Liquidity thins before price breaks. Now, let's get very clear on how a dual rate actually forms, because people talk about it like it's mystical. It's not. It's two doors to the same scarce asset. Door one is official, banks, regulated channels, official rate settings, approvals, paperwork. Door two is the street, cash availability, informal channels, exchange shops, speed, fewer questions, higher price. When Dr. 1 slows down because compliance tightens, paperwork bottlenecks, platform transitions, correspondent constraints, door 2 becomes the emergency exit. And emergency exits are always expensive. This is why the dinar versus dollar story is really a story about plumbing. Where do legitimate dollars come from in this system? In broad strokes, 3 places: oil revenues and government receipts that ultimately become FX supply, banking channels that can access foreign transfers via correspondence, and any formal mechanisms the central bank uses to supply dollars to the market. When those pipes are flowing smoothly, the official rate can anchor expectations, and the street premium can shrink. When the pipes get narrowed, even slightly, the street premium becomes the real-time truth serum. And Iraq has been living inside a reform and compliance narrative for a while now. There has been ongoing talk in Iraqi media about changes to the currency sale window and shifting away from older auction-like mechanisms, with an emphasis on correspondent banking, transparency, and controlling leakage. Whether you agree with every policy goal or not, the market effect is straightforward. When the system transitions, there are friction costs. Friction costs show up as spreads, and spreads show up as hedge demand. Because when people can't trust timing, they hedge. Not because they're bullish, because they're defensive. And that's why the parallel market matters more than the official press line this week. Now let's translate this into something finance-minded viewers recognize. The parallel premium is like a basis, 2 prices for the same underlying settlement value. In an ideal world, arbitrage compresses the basis. Buy the cheap one, sell the expensive one, pocket the difference, and the spread closes. But in a world with capital controls, paperwork constraints, enforcement risk, and limited legal channels, arbitrage can't fully do its job. So the spread can persist. It can even widen. And when it widens quickly, it's telling you that constraints, not opinions, are setting the price. Here's a simple way to see it. If the official rate is around 1,300 dinars per dollar for budgeting, but the street is closer to roughly 1,471,000, where 180 dinars per dollar, based on quotes like 147,800 per $100, that's roughly a low double-digit premium. That premium is not just panic. It's the market charging a fee for speed and certainty. And when the fee rises, it tells you speed and certainty just got more valuable. And that ES where the next detail flips the whole setup. The parallel market doesn't need a huge macro shock to jump. It only needs one bottleneck plus one deadline plus thin liquidity. You get the triangle, and price does what price does. Let's stack proof, because we're not doing single argument hype here. Proof point 1, the official anchor isn't moving much, and that's deliberate. Setting an official budget exchange rate at 1,300 for 2026 is a policy signal of stability. But stability at the official level can actually increase pressure at the street level, because it creates a perception that the peg won't adjust to relieve immediate demand. So the adjustment happens elsewhere. Availability, premiums, and parallel quotes. The volatility goes where it's allowed to go. Proof point 2, the customs prepayment rule is a clean why now trigger. It's a calendar catalyst. You don't need to guess motives. You just model behavior. If importers believe that beginning around early December, clearance requires duties paid earlier or documentation tightened, they front run it. They secure dollars before the rule bites. Traders, seeing the wave, may stop selling into the demand because why would they? If tomorrow brings more buyers and more urgency, the best trade is to wait. Waiting reduces supply today. Reduced supply today raises price today. That's reflexivity, not conspiracy, but it's just as powerful. Proof point 3, microstructure behavior was literally described by local reporting. Traders halting dollar sales, immediate pressure across provinces, noticeable volatility. That's the signature of a liquidity event. And liquidity events are jumpy. They gap, they overshoot. They then either normalize or spiral depending on whether supply reappears. Proof point 4, the government and central bank communications themselves acknowledge temporary fluctuations while insisting no structural imbalance. That's not meaningless. It is a tacit admission that the move can be driven by process changes and short-term squeezes rather than a collapse in fundamentals. And that's important for how you manage risk, because it tells you the market might whip violently even if the underlying thesis is correct. You can be right on direction and still get emotionally destroyed by the path. Proof point 5, the geographical consistency of parallel quotes matters. When Baghdad, Erbil, Basra are all quoting similarly elevated levels, that's not a single shop anomaly. It's a broad-based premium environment. That's the street symptom layer. And the street symptom is often the earliest alarm bell because it's closest to settlement reality. Now, if you're a macro watcher, you're probably thinking, okay, but Iraq is an oil exporter. Where's the existential problem? Exactly. The story is not no dollars exist. The story is the route dollars must take to become usable in the local system is constrained. This is the difference between gross reserves and effective liquidity. A country can have reserves and still experience a street squeeze if distribution gets narrowed. Think of it like a warehouse full of inventory with the loading dock closed. The inventory is there, but it's not delivering. So the customer pays more in the secondary market, not because the planet ran out of the product, but because access got rationed. And that's why paper versus physical language actually applies here, even though we're talking FX. The official rate is the paper narrative. The street premium is the physical settlement narrative. The official rate tells you what the policy wants. The street tells you what the system can deliver today. Now let AS do the mechanism explainer in plain English. How does a squeeze in the parallel market actually happen? First, a catalyst changes timing. Customs prepayment, tighter documentation, compliance checks, platform changes, any of that. Second, importers and businesses increase demand for dollars because they need them to settle obligations. Third, the street dealers anticipate this and reduce supply, either by widening spreads, limiting size, or outright pausing sales. Fourth, buyers chase the remaining supply, and because it's a cash and carry market with fewer market makers, the price can move in discrete steps. Fifth, the move itself attracts new hedgers. Households and businesses who were on the fence suddenly decide they can T-risk weighting, and they buy dollars as protection. That's hedge demand building. Sixth, that hedge demand creates the next wave of demand that justifies the dealer's decision to step back. That's reflexivity again. And if this one level breaks, the math changes. What math? The math of expectations. When people see the premium widen, they stop thinking in official terms. They start thinking in replacement cost. If you're a merchant and you have to restock imported goods, you don't care what the official rate is. You care what it costs to replace your inventory. So you start pricing goods off the street rate. That pushes domestic prices higher. That increases inflation anxiety. Inflation anxiety increases hedging into dollars. And suddenly, a process-driven FX squeeze becomes a broader behavioral loop. But, and this is crucial, loops can be interrupted. Which brings us to counterpoints, because we're staying credible. This can cool off fast. It can reverse violently. Why? Because these jumps are often mechanical and episodic. Once the market adapts to the new customs workflow, once importers complete a round of pre-funding, once policy steps in with liquidity measures, or once enforcement normalizes behavior, supply can reappear. And when supply reappears in a market that just jumped, you can get a sharp pullback. People who panic bought at the top become forced sellers. Dealers who held inventory can dump into the relief. That's why you do not treat a parallel market spike like a one-way escalator. So here's the real skill, separating trend signal from noise. Trend signal is the spread staying wide even after the initial catalyst window passes. Trend signal is a premium that keeps re-expanding on dips. Trend signal is when the street rate refuses to mean revert, even as headlines calm down. Noise is the first shock move, the overshoot, the rumor-driven whipsaw, the one-day gap that retraces the next morning. And volatility will try to manipulate you right here. It always does. It shows you a spike, makes you feel late, then it yanks it down to make you feel stupid, then it spikes again to make you feel trapped. The goal of the tape isn't to inform you. The tape's job is to force you into bad timing. And the crowd always learns this lesson the expensive way. So let's put a psychology shield around you before we go any deeper. If you are watching Dinar versus dollar through the parallel premium, you will see violent emotional price action even if the underlying pressure is real. That's the nature of thin liquidity markets. Quotes can widen. Transactions can freeze. You can get no price moments. People will weaponize that against your mind. They'll tell you the move is over. Then they'll tell you it's the end of the world. And both messages can be wrong in the same week. Your job is to stop taking the bait. Don't trade your emotions. Trade your triggers. Watch what forces participants to act. In this market, the forced participants are importers and banks dealing with settlement. The signal isn't someone's tweet. The signal is whether dollars are readily available at scale and whether the premium compresses without policy theatrics. Now let's talk about institutional behavior, because this is where skeptical viewers perk up. You don't need to accuse anyone of manipulation to understand incentives. When authorities tighten controls to curb smuggling and fake invoices, as economic commentators have openly said is part of the intent, some demand disappears, but some demand goes underground, and some demand becomes urgent instead of optional. That can temporarily raise the street premium even if the long-term goal is stability. Reform can look like instability in the short run. That's not a contradiction. That's the transition cost. And banks have incentives too. If compliance standards rise, if correspondent relationships are under scrutiny, if certain transactions are delayed or rejected, banks become more conservative. They don't want to be the one holding the bag, so they process slower, they demand more documentation, they ration access. Rationing access pushes more people to the parallel market. Again, mechanism, not mystery. Now bring it back to the title. Parallel market jumps. Hedge demand builds. Hedge demand is not just households buying dollars under the mattress. Hedge demand is businesses accelerating dollar procurement for imports. Hedge demand is merchants pricing goods defensively. Hedge demand is anyone choosing the asset that settles globally when they distrust local timing. And once hedge demand gets into the system, it changes the character of dips. Dips don't get sold. They get bought for safety. That's when the premium becomes sticky. And that's the turning point everyone is going to pretend they saw coming after the fact. So what do you watch right now? Not vibes, levels and triggers. The cleanest signal is the spread itself, the gap between the official anchor and the street quote. If the official rate is around 1,300 per dollar in policy terms, and the street is trading closer to 1,470, 1,480 per dollar, your first confirmation is whether that premium holds above key psychological thresholds on pullbacks. In many markets, round number zones matter more than precision. Think in bands. If the parallel market rate for $100 is around 147,000, 148,000 dinars, a pullback into the low 140,000s per $100 that gets aggressively bought would be a sign that hedge demand is still alive. If instead you see the rate compress back toward the mid 130,000s per $100 and stay there while liquidity improves, that suggests the spike was largely a one-off forced event that's now normalizing. And yes, I'm using ranges and conditions on purpose. Because fake precision is how you lose credibility in a market where quotes can vary by province, by shop, by time of day, and by whether anyone is actually willing to transact. Now, the why now calendar triggers don't end with customs rules. This is also a month-level story. Early January is a classic period for thin liquidity and reset behavior. Budgets, policy statements, payroll cycles, and New Year positioning can distort flows. If there are salary delays or fiscal bottlenecks, things Iraqi media sometimes references in the context of domestic liquidity, that can compound the demand for dollars, because people hedge against local purchasing power uncertainty. Even if that's not the main driver, it can add fuel. And in a thin market, you don't need a bonfire. A match will do. So let's build the two-scenario lens, because this is how you stay sane. Scenario 1 is the controlled pullback and retest. In this scenario, the parallel market spike was driven by front-loaded demand and temporary seller withdrawal. Policy responses, clearer implementation of the customs workflow, and reappearance of dollar supply bring the street rate down in steps. It doesn't go straight back to normal. It stair steps. You see compressions after interventions, then minor re-expansions, then a broader stabilization. The confirmation in this scenario is that each spike fails faster, and the premium compresses over multiple sessions without fresh panic. Scenario 2 is the continuation squeeze with gap risk. In this scenario, the initial catalyst reveals a deeper constraint. The distribution channels for legitimate dollars remain tight, the compliance bottleneck persists, and hedge demand doesn't fade, it grows. Dips get bought, sellers stay cautious. The parallel market starts behaving like a trend rather than a shock, and then the risk becomes discontinuity. Weekend gaps, sudden jumps, and days where the market opens higher because supply simply wasn't there. The confirmation in this scenario is not a scary headline. It's the premium staying elevated despite reassurances, and the street rate making higher lows over a 1 to 2 week window. Here is your risk framing in plain terms. Price can whip around violently even if your scenario is correct. That's not a caveat. That's the main feature. In markets like this, the biggest mistake is overreacting to a single print. The second biggest mistake is ignoring the spread and staring at the official rate like it's a live market. The official rate is an anchor. The parallel rate is a wave. You don't surf an anchor. Now let's talk about what would weaken or invalidate the squeeze thesis, because that's where trust lives. If you see credible evidence that dollar availability improves through official channels, faster processing, smoother transfers, fewer delays, and the street premium compresses sustainably, that weakens the thesis. If the parallel rate falls and stays down even as import demand remains steady, that tells you supply has returned or demand has been satisfied. If authorities implement measures that effectively reopen liquidity without simply driving activity deeper underground, you can get a real compression. And if that happens, you don't argue with the tape, you update. That's what serious people do. On the other hand, what strengthens the thesis is not just higher prices. It's behavior. It's sellers remaining absent. It's repeated reports of dealers pausing sales. It's the premium widening during periods where it should calm down. It's imported goods repricing based on street replacement costs. It's the system telling you it's still constrained. Now there's a subtle institutional angle that matters for the skeptics. When authorities are trying to curb irregular demand and fake invoices, they can temporarily create a liquidity squeeze that looks like instability, but the intent is to force demand into documented channels. That means, paradoxically, you can get a hotter parallel market in the short term as the market adjusts. If you're watching only the headline, reform, stability, official rate unchanged, you'll think nothing is happening. If you're watching the spread, you'll see the adjustment cost in real time. And that's why everyone's watching the headline, but the signal is somewhere else. So what happens next week? Here's a practical checklist that doesn't require you to be an insider. First, watch the parallel premium daily, not the one-off quote your cousin saw, the repeated band. If the band stays elevated and dips are shallow, hedge demand is still bid. Second, watch for policy timing. The market reacts less to policy statements and more to operational changes. What gets approved, what gets delayed, what documentation is demanded, what deadlines are enforced. The moment the process becomes predictable, premiums can compress. Uncertainty is a tax. Third, watch for thin liquidity windows. Weekends, holidays, and low-volume sessions are where gaps happen. If you see jumps clustered around these windows, that's a liquidity signature, and that's where the real pressure starts. Fourth, watch imported goods pricing as a secondary indicator. If merchants keep pricing off elevated replacement costs, that suggests they expect the premium to persist. If they start discounting or stabilizing without fear, that suggests confidence is returning. Fifth, watch the psychological game. If you feel the urge to chase a spike, that's your signal to slow down. If you feel the urge to capitulate on a dip, that's your signal to zoom out. You don't have to be fearless, you have to be systematic. And now let's do a quick, grounded thought experiment that makes the mechanism obvious. Imagine you're an importer who needs $200,000 to settle a shipment. At the official rate, the dinar cost is lower, but the official channel has paperwork, timing, and uncertainty. If you miss your clearance window, you pay storage, you lose sales, you damage relationships. So you decide, I'd rather pay a premium today and guarantee the dollars than risk a delay that cost me more than the premium. That's not speculation. That's operational risk management. Multiply that decision across thousands of businesses, and you get a parallel market bid that doesn't care about cheap or expensive. It cares about available. Now flip it. You're a dealer with dollars. You see policy tightening, you see forced buyers, you see uncertainty. Your risk is selling today and watching the price jump tomorrow. So you ration, or you pause, or you quote wider. That behavior reduces supply. Reduced supply raises the premium. Premium attracts more hedgers. More hedgers validates your caution. Reflexivity locks in. This move isn't emotion, it's math. But math doesn't guarantee direction forever. It guarantees pressure. The release valve can be a pullback, a stabilization, or a squeeze. Your job is to watch which one is forming, not to swear loyalty to one narrative. So here is the cleanest way to hold this in your mind without getting sucked into noise. The official rate is policy. The parallel premium is availability. Availability is what businesses and households are hedging. And as long as availability feels uncertain, hedge demand builds, because the cost of being unhedged is higher than the cost of the premium. Near term, the levels that matter are not magic numbers. They're zones where behavior changes. If the parallel market keeps trading near the high 140,000s per $100 and fails to compress meaningfully, you're in a squeeze-prone environment. If it compresses back toward the low 140,000s and then rebounds, you're seeing dip buying and sticky demand. If it compresses sharply and stays compressed, the event may have been a one-off front run that's now unwinding. And don't let anyone shame you with certainty. In markets like this, certainty is usually a marketing strategy. Serious analysis sounds like this. Here's the mechanism, here are the triggers, here's what would confirm it, here's what would invalidate it, and here's how you avoid getting emotionally harvested by volatility. That's the whole game. One more thing before we close, because this is the last trap that eats smart people. They confuse right thesis with right timing. You can be correct that hedge demand is building and still get wrecked if you chase an overshoot. You can be correct that a pullback is likely and still get wrecked if a squeeze gaps through your expectations. So if you take nothing else from this, take the discipline. Position sizing and time horizon are risk management, not afterthoughts. Price can whip around violently, even if the fundamentals and plumbing are pointing the same way. If you're the kind of viewer who wants the next shiny headline, this market will eat you. If you're the kind of viewer who tracks spreads, watches deadlines, respects liquidity, and updates when the tape changes, you'll see moves earlier and you'll survive the path. And that's the quiet edge most people never earn. And if you want to keep building that edge with a community that doesn't worship narratives, only mechanisms, stay close to this channel Weir-S style of thinking. Not because you need permission, because the crowd is loud and the spread is honest, and it helps to have a place that keeps you anchored to what S real when volatility starts lying to your face. Watch the premium, watch the deadlines, watch liquidity. And remember, the official rate can stay calm while the street rate is doing the real price discovery. The moment that spread stops compressing and starts building again, you'll know hedge demand isn't a theory anymore. It's active flow, in real time, right now, this week.